Hi, my name is Nat Coates. I'm here with Lyn Adams, who's the president of Adams Financial, and we're here to talk about tariffs, the economy, and how that affects the markets and investment performance. Lyn?
Hey, that's the hot topic today. We see the markets moving around a lot with news each day about the tariffs. Are we going to get a deal? We're not going to get a deal. And I just think it's important for our clients to have a little bit better depth of grasp on how this is going to play out. One of the things that's important to realize here is that China, became the second largest economy in the world over the last 35 years. And they did that out of a very, very small beginning, and they did it strategically with some policies that they have in place. And when we start talking about trade deals, we're really kind of pulling them to go against these policies that have made them a global superpower, right? So for example, many years ago, the Chinese decided to peg the U.S. currency. When you make your currency peg to another country's currency, you take away the country's ability to navigate how much they want to make their goods and services cheaper or more expensive. Because if we want to change the valuation of our currency to get more attractiveness to U.S. prices, it benefits China because they're pegged to our currencies. Another thing that China does that's a part of the deal is they have what's called government subsidized labor. So, in an economy like a capitalist economy we have here, you go out, you work, you charge a wage, and you get paid, and you compete for your services on the open market. In China, it's very important to the Chinese government that their workers always stay employed, that the millions of folks coming out of colleges have jobs. So the government itself actually provides money to subsidize labor costs to keep all of their citizens working as much as possible. We don't have that here. Another thing that creates an imbalance with the U.S. and China in terms of competing for global business is that when it comes to making goods and services, the Chinese government will subsidize their corporations and make their products cheaper because they're giving them money to help pay for some of the costs to create the products. So if we have a U.S. company like Cisco going to go and make routers and sell them all over the world, well, China can make pretty much a virtual copy of that router, and their government can pay 30% of the cost and make it so they can sell it for 30% less, making it not a competitive environment. And that's a policy that China's had for a long time. And then another piece of the Chinese issue is that they don't really have an enforcement on the concept of intellectual property infringement, right? If we have a great idea here in America and you get a patent on it, if someone down the street wants to copy your idea, you have protections. In China, they don't really offer those protections. So they don't spend the same amount of money in research and development that we spend here in the U.S., which also makes it an unfair playing field. So President Trump, in his agenda to get a fair trading deal with China, is really etching into all four of these categories. It's not a simple solution. So I think that we as investors, we have to realize one thing above all else, right? That because this is such an ingrained policy in China, that it is not a short-term solution. It would be highly, highly unlikely that we get a trade deal that comes out of the negotiations with their government and our government in the short term, because we're talking about peeling back layers of the very fabric of their economy for the last 35 years. So I think we have to be patient as investors and realize that the noise about we're going to get a deal, we're not going to get a deal, it's really mostly noise, all right? Ultimately, I think President Trump, what he is aiming for is a system to level the playing field where our workers can have the opportunity to compete for the business that the Chinese government has been artificially making an unfair advantage for. And his view, President Trump's view, is that the best way for our economy to continue to be the leading economy in the world for the next century is through labor, through us having our own labor capacity, us competing for work, competing for jobs, goods, and services. So I think we have to stay focused on it's the long game that Trump is fighting for, I think, when I interpret the things that he says and what we see him do. It's not the short-term gain, right? And in the end, if we can get to that fair trade policy, I think that's a big win for our future. But that said, there's going to be pain.
And Lyn, tell me what some of those pain points might look like.
Well, let's think about a few things. For one, in the short term, the actual tariffs. When American consumers or American companies have to pay 20% more, 30% more, 15% more for goods or for raw materials, somebody's got to pay that price, right? And initially, it's been the American consumers, right? We're trying to build a house right now. We're talking to the builders, and they say, hey, in the last 6 months, the prices for raw materials have gone up 20%. Well, the consumer is going to pay that price. American businesses are going to pay that price. The businesses want to compete. They want you to buy things from them. So they're going to eat some of that margin to make the price still affordable. But ultimately, the rising cost of goods is a problem in the short term, right? Now, the solution to the pain is really when American companies innovate. They say, wait a minute, we'll make that here. We'll create that resource here. And they invest the money to build new facilities, new plants, new manufacturing locations. They put in the technology and the automation and the labor force here to then replace the need to get things from China, right? So for American businesses to fully integrate that into the actual process, I think we're talking about a 5 to 10 year horizon. Well, investors, they're looking like what's going to happen 5 to 10 days from now, right? Are earnings going up, going down? So the pain is going to be consumers are going to pay more, American businesses are going to have less margin, which is less profit, and investors are going to have to grapple with the fact that earnings are going to be lower until we innovate around the cost of the tariffs.
And Lyn, how do you think these costs will affect investment returns?
Well, the price of the stock market today is the best guess of analysts to derive at a number that represents today's value for tomorrow's earnings, right? So if the cost of the tariffs end up having a 10% impact to profits, well, that could translate into a multiple of 10% that would, in the short term, be pushing prices down, right?
Right.
Stocks trade on multiples of earnings, so it really ultimately becomes a question of how much tariffs and how much negative impact to earnings will it have. But I'm telling you, I believe that the American capitalistic culture is innovative and bright and hardworking, and I believe that we will innovate quickly to resolve the cost problems. The problem is we won't start the process of innovating and retooling until it's a certainty, the path that we're going to take, right? Because no one's going to spend that capital to do it until they know this is how it's going to be from now on. So in the near term, I would expect lots of volatility, but I would imagine that over the next 2 to 3 years, as we see more U.S. workers tooling up to manufacture and produce American-made goods and services, I think you'll see that has a bigger shot in the arm as a boost to the economy for the next 5, 10 years. So in the near term, it's going to create volatility, probably some challenges. In the longer term, I think it's a good thing for the markets. I think the last thing that I would say is that when you are older, and I don't claim to be as old as some of the people that I serve, but I'm 25 years into doing this, you begin to think about what's going to be here for the next generation. What's our children's future going to be? What does the world of opportunity look like for our kids? And when I was young and going through college, there was an expectation that every generation would have a better standard of living than the generations before that, right? My parents had a better standard of living than their parents, and so on and so forth. When we got to the end of the 90s, I think that belief in the American future fundamentally shifted because of globalism. And I actually believe that if we, as a culture, can transform this problem into something that creates job opportunities for the future for Americans, I think that our kids' future is going to be brighter because of it. We may not ever get to appreciate it truly as investors in this decade, but long term, there's a reason China has become the second largest superpower in the world in the last 35 years out of basically a nothing economy before that. It's because they've taken these tactics and applied them to their advantage. And if we can get it back to neutral, I think that's a great thing for our kids for the long run. So it doesn't help us in terms of navigating the markets today or tomorrow, but with our strategies here at Adams Financial, I mean, we have strategies to deal with volatility. We have strategies to deal with good markets and bad markets. I think this is more about the long run for our children and their children. And there's going to be bumps in the road, and I'm not by any means saying President Trump has got it all right, but when you really look at policies that make it more a level playing field between us and the rest of the world, I think it's a good thing.
Well, Lyn, thank you so much for sharing your thoughts on tariffs and the economy. We'll continue to update you as more developments take place.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
The views are those of Adams Financial and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 Index is an unmanaged index representing the largest 500 companies in America. The Barclays Aggregate Index is an unmanaged index representing the overall bond broad market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Past performance does not guarantee future results.